So I spoke with him and I said, it's great what you're doing. You're changing the world. It's fantastic. And he was like, well, there's nothing to invest in. And I thought, well, the world's kind of a broken place. How is there nothing to invest in? So I thought I should focus on solving the pipeline problem. The question is, how do you make a startup successful? The first element has to be for profit. Although we are definitely impact investors, the first step is to look at a business and decide whether it's a viable investment. Entrepreneurs are the most important element by far. Being a founder of a startup is a bit of a lonely job. So ideally, you want people around you that have skin in the game that also can help extend the opportunity that you have. Adaptability is a Darwinian thing, not the strongest, but the most willing to adapt. But if you focus on the work ethic and the work output and just bring as many opportunities as you can, you just have to bat more than 500. You just have to have more things working than are not working and then be patient. I see so much tech for good that is actually greenwashed. They want to kind of say they're doing this for a good reason, to get support for it or to get funding for it, but actually it never goes to the people that they claim are the beneficiaries.
Gordon, thanks for coming on the show today. I've been really looking forward to sitting down and talking with you because I've always wondered if anyone working at NASA ever says the joke, well, it's not rocket science. And that's because you are literally a rocket scientist who did work at NASA. And your career has gone from rocket scientist to international investment banker to impact venture capitalist. So not a straight rocket trajectory by any stretch of the imagination. But before we get into all that, your first 3 degrees are all from California universities. Does that mean that's where you grew up?
That's correct. So first of all, thanks for having me, Scott. It's great to be with you. I could say I wish that all of that trajectory was deliberate, but a bit of it is kind of you take it as it comes. I grew up in California, and I did my undergraduate studies at UCLA, where I was interested in both engineering and economics. So I got a degree in both of those, and then decided after college to use the engineering degree first. So I started working for, at the time it was Ford Aerospace, and later was purchased by Loral Corporation, so Space Systems Loral, where I would design spacecraft components and also launch spacecraft.
And then you moved to Northern California, to Santa Clara. Was that before or after that?
Well, so actually I grew up in Northern California and then went to school in Southern California, then ended up, Space Systems Loral was up in Palo Alto, so then back to Northern California. And then kind of out of just wanting to be better at understanding a lot of the technological, developments that were happening, I ended up doing a first master's degree while working at Santa Clara, and then was actually going to get my PhD at Stanford. And then after a year, decided to step away from that just because the kind of changing landscape with the end of the Cold War made research engineering and aerospace kind of not what I wanted to, not like the long career path that I was hoping it was going to be. Aerospace is interesting. Right now it's really sexy again, but it's definitely gone through ups and downs depending a lot of times on budget and people's interest.
You went to the University of Chicago to get your MBA. What was behind that transition?
It kind of was a function of a lot of what I did in aerospace. I really enjoyed it, especially at the end. I was actually launching spacecraft, but kind of the challenge with aerospace at times, especially on the research side at that time, was that there was just not a lot of new research going on. It takes a long time for things to kind of get developed. And I wanted something to be a bit more fast paced. Didn't quite know what I wanted to do. I actually then, I contacted some of the very early venture capitalists on Sand Hill Road. So this is like 1992, before, the industry really even existed. And I remember I think it was at Sequoia. One of the guys there said, you need an MBA. And I was like, are you kidding me? I already have 3 degrees. It's like, this is ridiculous. Or 4 degrees. He then said, no, it'd be really good. And so then, and he also said, you're kind of a bit California. So I thought, okay, so why don't I go a little further afield? And I liked Chicago because my focus was analytic finance. And ultimately, I actually got to have classes with 4 Nobel Prize winners. So that was pretty cool.
And then you made a huge jump into investment banking at some really blue chip iBanks. like Goldman Sachs, Morgan. Talk me through that. That spanned quite a few years.
Yeah, so I actually, going into B school, I don't really think I knew much about investment banking at all, but I became very interested. I ended up doing, between the 2 years, I did my summer internship with Goldman here in London. Back then, it was a much smaller organization. So globally in investment banking, there were only 100 associates hired that year. And we did our training up on the top of the World Trade Center. So that was an amazing kind of month of training that we did up there. I stayed with Goldman for a while. And then in 2000 timeframe, kind of technology was really starting to take off again. And even though I was doing a lot of different types of M&A, everything started moving a lot more towards tech. And I was approached by Morgan Stanley and joined them in 2000 and then ran their technology banking practice for a while until 2004. So I got to kind of see the rise of the bubble, but also kind of when it stopped being as fun as it was, let's say between 2000 and 2002.
You were at Goldman, Morgan Stanley, then you were at HSBC.
Yeah.
But you were moving abroad and all that, right?
What happened was, so starting around 2002, I still had all my tech clients. So, Nokia, Siemens, Infineon, ST Micro. So I focused a lot on semiconductors and telecommunications. And all of them, starting in 2002, started asking me about Asia, which I had really not much knowledge about. So that became a trip to Asia, which became a quarterly trip, which became a monthly trip, until all of a sudden I was working on a lot of transactions in Asia. And then one of my mentors who had hired me into Morgan Stanley left to become the co-head of investment banking at HSBC, and knew that I was very interested in Asia, so offered me a role. So I moved with my family I still don't know how I convinced my wife to do this, but moved with the whole family to Shanghai in 2004. So we lived there for a few years.
That was a great period, though. The whole situation is totally different now. So you got to the end of quite a long run of those four banks, because you also had Crédit Agricole at one point as well, right?
Basically in around 2008, shortly after the financial crisis, beginning of 2009, I got a bit fed up with large banks, because it always seemed like their strategy would change all the time. So we're going to do more of this, we're going to do less of that. And I thought about it, and I felt like what I really enjoyed was kind of the client aspect of it. So I left and launched an advisory firm, and basically went back to many of my former clients and advised them on mergers and acquisitions, and also financings and all kinds of strategic advice in that regard. And that was interesting, fun. But one thing that I had kind of started developing when I was living in China and spending a lot of time traveling around Asia was effectively what were the best investment opportunities in Asia. And I felt quite strongly that most people actually did not understand kind of actually what they were buying when they bought the emerging markets index was actually not what they actually thought they were holding. So in other words, if you look at the emerging markets index, first of all, more than half of it was South Korea and Taiwan, which are actually not emerging markets. And then other countries at that time, what you were investing in was the large banks that had international exposure, and not really what was happening domestically, which is where all the excitement was. Ultimately decided to launch a hedge fund in 2011 where we focused on up to 30 small caps, so public companies, but 5 billion or less in a handful of emerging markets, with the view that this was where the opportunities of growth were in those emerging markets in terms of the kind of the changes mostly happening because of technology. And they were so dramatic. If you think about an emerging market, the difference, let's say in the US or Western Europe, we were going from we had a fixed line, but then all of a sudden we had mobile telephony, whereas in emerging markets, they had no fixed lines except for in the cities. And all of a sudden they had ubiquitous mobile telecommunications. So trying to capture those opportunities is what we focused on with the hedge fund.
You said you founded an advisory, and a hedge fund is one of those, Aperios Partners, or is that both of them?
So the advisory firm is Aperios Partners, and then the hedge fund was Aperios Partners Investment Management, which I ran until 2016 and then shut down.
So that takes us almost to the present. In 2020, you founded 3 different ventures. One is Opto Impact Ventures, Second one is Chorus Angels Network. And the third is an accelerator called Impact Central. What led to this, leaving Aperios behind and doing this and in the middle of COVID all times?
So I actually have to back you up a couple of years before that. So in 2017, after I'd closed the fund, the Emerging Markets Fund, I became interested in impact investing. And it was a couple different elements came about. Part of it, my oldest daughter was I think 17 at the time, so was asking me kind of, there's all these issues, what are you doing for the planet, Dad? And I was like, haven't really done much. So I started thinking a little bit about the structure of a lot of my clients and a lot of the transactions I'd worked on, and kind of where the progression of that was from a societal, environmental, global perspective, and kind of agreed that that needed to change, and went to a number of conferences, became quite interested. Initially, I thought my highest and best use, if you will, was that I was going to speak with my former clients, so S&P 500, FTSE 100 chief executives, and I met with a number of them, or board members, and I would tell them, you got to do things differently, and we would have a really nice lunch, and they would say, Gordon, you're right, we need to do that, but no, right now we got these other problems, or we got a committee working on that. And after about 6 months, I realized that I was going to have zero impact. If I looked 5 years down the future, the only thing I would have had was a lot of nice lunches and dinners. I was kind of in that thought process, and remembered a close friend from business school had just started working on an impact fund. So I spoke with him, and I said, it's great what you're doing. You're changing the world. It's fantastic. And he was like, well, there's nothing to invest in. And I thought, well, the world's kind of a broken place. How is there nothing to invest in? And for your audience members that are kind of knowledgeable about how funds and asset management work, you're fundamentally, in a way, captured by the size of your fund. So he had launched inside a larger group, and they gave him $500 million right at the start. And so as a result, his minimum investment size was kind of like, very minimum would be like $25 million. And he was just complaining that, frankly, there was no pipeline. There was nobody was supporting smaller companies to come through that had interesting impact theses. So I think he's a brilliant guy. And I thought, well, I'm not going to why would I find better opportunities that he's looking for? If they're there, I think he would be finding them. So I thought what I should focus on instead was solving the pipeline problem. So when I looked at the pipeline problem, it was in many ways also a very interesting problem, because it also includes entrepreneurs, startups, all those issues, operations, etc., which I've kind of always enjoyed also looking at. And in 2018, so January 2018, I joined an organization and launched an impact accelerator. So that was the first accelerator that I launched. We then ran 4 more, that one plus 3 more in 2019. And then, as you say, COVID hit, and then we changed the structure. It became Impact Central, and then we've since run another 6 cohorts. So 10 cohorts, 54 startups have come through. Tends to be a 3 to 6 month program where we do a number of different things we can talk about. But just let me get to Chorus and Opto quickly. So the accelerator was kind of the initial, let's say, solution. But I quickly came to the realization that most of the startup founders really had no idea, no experience with how to raise capital. So because I still had advisory firm, I was able to work with some of them and raise, in aggregate, I think we raised something like 6 or 7 million in small chunks for a number of small startups, typically between 50,000 and 500,000 of investment. And so that was trying to bridge. So we created Chorus to bridge the gap between the startup founders that needed financing and the investors who were looking, generally high net worths or family offices, looking for investment opportunities. That seemed to be the full solution. And then a lot of those investors who initially said, I want to do my own deals, then would say, doing your own deals is a lot of work. And I was like, yes, it is. So they said, could you do a fund? So about a year ago, we started working on that, and we did a first close, so small amount of $1 million for Opto, where what we do is we find the investments, we take board seats, and then we focus on really rolling up our sleeves and helping the founders out. and then with additional investment and whatever is required to bring them to scale.
You mentioned with Impact Central cohorts.
Yes.
So explain what that is. And you said, I think you had 6 or 10, something like that.
The way you need to look at an accelerator, it's kind of about economies of scale, right? So program that we ran, we had amazing, kind of authors and all kinds of people that were experts in different elements of marketing, or we would do a lot of the finance stuff ourselves, but we'd bring experts on board for 1 week at a time to work with founders. So the question though is, how do you kind of get that to achieve economies of scale? And the way you do that is you run kind of a program. So we would do a 12-week initial program that was just intense. Like they'd always be a bit wiped out by week 8 or 9 because of the intensity of it. But then the second half, so the next 12 weeks, we would create a mentorship program where we would, instead of having weekly kind of things they would be learning, we'd have some mentors that were specifically selected for either their business or what they need to do to change their opportunity set as a startup to come on board and help them. So we would gather anywhere from 6 to 10, it was the ideal number, of startups together to go on this journey together, because there's also a lot of learning that happens between them. So they challenge each other to kind of look at, well, this guy was saying this about your marketing. How are you going to incorporate that? So those groups of 6 months in total, we've run 10 of those. And then in aggregate, if you add up all the individual startups per cohort, so the average is 5.4, but 54 over 10 cohorts. That's 54 startups have gone through the program.
So at Impact Central, take us through that. I definitely want to hear the story on how you secured the first accelerator location for Impact Central.
This is, kind of it's kind of the challenge is to find a way that you can get 6 to 8 disparate founders, like people that are doing totally different startups. How can you create something that's beneficial for all of them and takes them to a point where they can then, get funding and actually grow their business? And as it turns out, when you analyze that, there are certain things that actually everybody needs to do well. So one thing is communication. So we had a gentleman his name's Steve Cockram. He's founded a leadership company called Giant, and he would spend a couple days with the cohort and talk to them about how do you communicate better to your team, et cetera, to build your team and to, demonstrate leadership and build that up. And so we would, as I said, we would have a different module every week, but in order to do that well, we needed to get people together. So we needed a location. So when I started the accelerator, I was like, okay, what do we need? We need a program. We need some, great startups. We need a location, and we need some capital. And kind of all 3 of those, except for the location, kind of came together. And so in many ways, it was quite amazing. Over the course of 8 to 12 weeks, all of a sudden, all of this stuff was falling together, and we were going to launch the program on I think it was like the 18th of April, 2018. And I still didn't have a place. So it's like, where are we going to meet? And this was pre-COVID. So people would not have accepted a virtual type of accelerator. That didn't exist back then. So as every day came, I was getting more and more, nervous about this and going, oh my gosh, I have all these amazing, I have a guy, Dave Evans, who'd written Designing Your Life, which was a New York Times bestseller. He was going to talk to them. And I had all these great speakers really excited, and I had no place. And I was like, after all this, is it all going to fall apart? I got to pretty much the final week, and I was like, okay, if I don't have a place by Friday, I'm going to have to pull the plug and tell everybody, we're not going to start in 3 weeks' time. I am a man of faith, and I kind of felt like, okay, I got to pray about this. What am I going to do? And I kind of got this sense I have to start calling these numbers. So when I walked out of my house, I would walk up this road to where my office location was, and I would see these signs from commercial real estate guys. And so I got this sense I should just call these numbers. So I'm walking down the street, come on the first one, I call the number, I get a voicemail, and I said what I'm looking for, and I hang up. Next one, somebody answers. And I said, I need a location. And the guy said, well, how much do you have to spend? And I was like, I got nothing, So he's like, really? So this is not going to go well. So I keep doing this. I'm walking down the street very slowly because I'm making all these phone calls. And about 15 minutes down the street, the very first number I called, the guy calls me back. Same dialogue. How much can you spend? I'm like, nothing. So he's like, oh. Well, he said, well, have you thought about Landmark House? And Landmark House was a building that they were going to tear down in a couple of years' time, but it was still 80% occupied. And I said, yeah, I know they got a co-working space at the bottom. I need like 5,000 square feet because I got to run a program in there. And he was like, no, the 7th floor. And so I said, what do you mean? He said, well, the tenant recently moved out. And he said, you want to introduce you to the owner. And so, frankly, he knew the owner. So that afternoon, I was up in the top floor where they had their management office and sitting with the owner. And because we were doing impact, he liked what we were doing. He was very, kind of thought this is great. And so I gave him the whole story, why all these businesses were going to be helping. You got environmental, it's amazing. And he's like, really? And he was, okay, so, well, how much can you pay? And I was like, nothing. And he looked at me, and it was one of those moments, like when you're in a negotiation and whoever's going to blink first is going to lose. But I'm sitting there and I'm like, I have nothing to offer. So it's like there was no chance of me blinking because I had nothing to offer. And so it was the most uncomfortable silence for about 30 seconds. And then he said, okay, I'll give you a call back. And so as I walked out of his office, I thought, okay, this one's not going to happen. And an hour later, he called me up and said, okay, you can have it. And so we ended up with 4,000 square feet. And that's what we needed because we had all these, different people coming in and doing different things. And we needed a co-working space for all the startups. So that was a kind of miraculous arrival, which kicked off the start of all of these accelerators that we ended up running.
So when he said you can have it, what was the story behind the story? I'm sure he didn't say you could have it forever or what. Yeah.
So ultimately, the way commercial real estate in London works is typically people do usually 10, but at least 5-year leases. And then that becomes a problem for landlords if they're looking to then tear the building down, which he was looking to do in a year or two. And so probably about a year. So he said, look, you can have it for the next 9 months. He wasn't going to bring anybody in because nobody would want to come in for 9 months. So he knew he couldn't get that type of a commercial tenant. The great thing was it was in great shape. So we didn't have to do anything. We just built a stage and that was it.
That's a great story. Impact investing, that's a term that's used a lot and fashionable today. What is your mission or your focus? What kind of impact are you trying to achieve with your activities? It's
a great question. And I feel like impact investing was around in 2017 to a certain extent. It's kind of ballooned to a large extent since then. And in many ways, kind of what you're alluding to is that there's so many different definitions that people use in terms of what do you mean by impact investing? What's purpose-driven investing? What exactly are you looking for? And so I think it's helpful. This is something that, I spent a lot of time on before we even started to get clear in my head. The premise that I arrived on was that, as I said earlier, I feel that the structure that a lot of corporations are operating under is not conducive to change in terms of taking into account the social or environmental damage that's being caused. The reality, of course, is that businesses represent the majority of our economic activity. So it's going to be very difficult. And this is where if you look at kind of the trade-off of like, well, people say, oh, well, a charity can handle that. If you look at kind of the funding of charities or the size of charities relative to the size of our corporate or, commercial economy, it's dwarfed. So, it's very difficult to try to solve some of these problems if we don't get business involved. And so what I felt, though, was that fundamentally, can large companies do this? Yes, large companies hopefully will be part of the solution. But the problem is that the inertia of spending, whatever, $100 million on a supply chain, you're not going to dismantle that. It's very difficult. So, the people that I mentioned earlier that are, friends of mine, former colleagues, former clients, they're good people. They work at large companies. They want to make a change, but they would argue that, well, my shareholders, my board members, whatever, I can't do this. So the inertia of that makes it very difficult. So what I felt was that, okay, if the large companies can't do it, can small companies do it? And will that matter? And the conclusion I came to was that the advantage that a small company has is they have a blank sheet of paper. They can design a totally different approach that could be more efficient, that could be more competitive because it's taking different things into account, as opposed to just reduction from, the large corporate structure. So they could take a totally different approach. However, they do need to be profitable. It has to be a for-profit business, because otherwise you're going to run it. You can't constantly be financing this thing. It has some of its success. Also, one of the ways that you know it's working is that you have customers that are willing to pay for your products or services. So I always felt profit is a really key element to it. So it's what we were looking for were profitable startups, but that also had a social or environmental kind of purpose that they were aligning with their business. And one of the questions we always got was, well, how do you find it? Is it this type of business or this type of impact? And it turns out we could actually be agnostic as to the individual business or the individual impact. What we require is that they work together, because if they work together, then you really don't have a problem supporting the business, because when the business becomes more profitable, the impact grows. So that's kind of the core thing that we always needed. Of course, you need to look at the business individually to make sure it can be profitable. And you have to look at the impact very carefully to make sure that it's viable, that it makes sense, that it's not de minimis, and that, you could actually demonstrate an improvement. But subject to those two, the key thing was that it actually works together so that it's kind of cumulative and that you can build momentum where the business that you're growing is constantly growing the impact also.
Are there social and environmental macro trends that you believe can best be solved by purpose-driven startups?
What I've come to learn, over kind of the experience. So as I mentioned, we've run 10 cohorts, but we've probably had more than 450, I think, applications. So I've seen tons of startup ideas. And then I've even had more conversations with people about, would this work or would that work? So what has kind of come out of that is, I would say, on the social side, most of the social opportunities have to do with something like the problem of social exclusion. So in other words, if you think about, and then on the environmental side, I would say that the problem is typically one of the fact that we don't actually fully cost environmental issues in normal, businesses typically don't pay for the environmental damage that they cost, because arguably if you could get the regulations right, that would be one thing, but fundamentally we don't kind of do that calculation. So if I go back to the social one, what I've seen that works well is kind of identifying, like we have one business that is a coffee roaster that also trains and employs ex-offenders. And the reason that works so well is that from a societal point of view, there's a real social exclusion issue if you've gone to prison. Fundamentally, it's getting worse with AI, because what ends up happening is most jobs are now, you get a job mostly digitally, like, you apply for it, hundreds of people apply, something gets sifted, and so many people get identified to be interviewed or whatever. And if you've ever been to prison, no one will ever hire you again. So that's kind of the first problem that you have. So you need a business that would actually consider training, because they also need trainings. You have to train an ex-offender. It turns out that there's actually certain characteristics. So you can't train everybody who's ever been to prison, but some of them that, have the right approach, and they for whatever reason, they're interested in coffee. They're interested in, maybe working in a cafe, potentially owning a cafe at some point. One of the great things that they do is they stick around. So if you talk to cafe owners, the major problem they have with baristas is baristas are temporary employees generally. They're people that come for 6 months, a year, and then they leave. So cafe owners are always kind of suffering from having to find employees, yet ex-offenders are looking for long-term employment, and frankly, minimum wage is great, because the alternative is nothing. And what we do know is that for an ex-offender, if they don't get employed, the reoffending rates are 70% if they don't find a job within like a year. So there's a number of characteristics. Coffee, there's a certain amount of manual labor required in it. There's a number of benefits to kind of how that can work together with the training elements of it. And so that's one example of, where you can marry up a social issue and a business opportunity, and they actually help each other. On the environmental side, I would say it's the opportunities there tend to be where kind of the direction. So like on that one is, to continue to use like a kind of coffee as a point. Coffee has become more and more, larger and larger companies like Nestle. Like Nestle buys 1 in every 10 coffee beans globally. And so what ends up happening is that their efficiencies, which are massive because of the massive economies of scale, gradually has reduced in lower quality. So they treat the coffee supply chain as pretty bad. But the thing is that if people are willing to pay a bit more to get better coffee that had in typically small farmers that are treated better, that get paid more, actually produce better coffee. So there's an opportunity to make a differential there. Or other supply chain issues where, whether it comes down to ingredients or other things, in terms of what the industry as a whole has started to become hyper efficient, then you have generally a quality reduction where you can actually, as a smaller company, demonstrate a higher quality product. And also, fundamental to all of this is that people care. And what I mean by that is the reason this works is that what fundamentally has to be true is that consumers now actually know about these things and they would like to vote with their wallet. So fundamentally, though, for that to happen, they have to have choice. They have to have a business that is offering a product that's comparable. And it can't be, yes, you can be massively, environmental or socially benefit if you're wealthy, because then there's people out there that'll sell you, the most environmentally friendly socks ever, but they're $50 a pair. That's not really helpful. What we really need is for that to be at scale so that everybody could buy it. So, for example, we've worked with a company that focuses on women's underwear and uses plant dyes and regenerative cotton, but at a price point that could then everybody could buy it, as opposed to $50 a pair where only very few people are going to purchase it.
The accelerator, how many companies do you have at any one time? Or is this a moving target? 54 have gone through the program, and typically we would do 3 in a year. So we have 3 starts, and then when one group is finished the first 12 weeks, the next group starts the next 12 weeks, so that we always had kind of two at the same time running. So that's because the mentor program is different from the actual training side of it, the first 12 weeks. You're not actually incubating. This is more like coaching. That's a good point. I think it's an important kind of differentiation to make. What is the difference between accelerating and incubating? The way I would define it is that when you incubate, you don't really set a time scale. You kind of identify, and sometimes on the investment side, as Opto, we've looked at more of kind of an incubation model, whereas we're working with one particular company. We're trying to identify however long it's going to take, because we're now investors. We have a board seat. We're trying to help them with whatever elements they need to be successful. That's not going to take, it's not a defined 3-month process, 12 weeks and 12 weeks. So what's the purpose of an accelerator? An accelerator is really, there's a ton of ideas. We had, 450 or so people apply. You look at the applications and you get people at always early stage, but at various kind of with different types of ideas and trying to figure out, does this have legs? Could I get someone to support it? Is it investable? And so we would down select that to the ones that we all felt, okay, on paper and having, done a couple interviews, this sounds viable.
the founder has the right background. They understand the impact well enough. It's not just kind of a fuzzy thing. And also they have some knowledge as to what it would take to make the business successful. So from that starting point, then we have to say, okay, what can we do? And there we could actually run it as a fairly solid program to say, here's all the things that are missing that you have to upgrade in order to have a much higher probability of success in getting someone to invest.
Moving to Chorus, is that a network of angel investors and high net worth individuals that can write small tickets, I suppose?
It's a very difficult slice that we're trying to get financed, because what you find is that people that will invest anywhere from, let's say, 10,000 to 100,000 into a startup venture, they have to have a certain amount of wealth, because this is risky. They could lose that money. So they have to really believe in the opportunity, or it does something that interests them. That's kind of what you have to find in those types of investors. They tend to be individuals, family offices. They have a minimum investment side typically of, 250, 500, even $1 million would be small for a lot of family offices. So yet at the same time, you can choke a company if you give it too much capital. They'll get distracted. It's like, for example, we'll bring people on the program and we're like, okay, the UK is a big enough playground to figure out if this is going to work. So, they'll start off telling us, well, next year I'm going to Europe and then I'm going to the US. And we're like, look, just make the UK work, or even just make Greater London work, to show us how that's going to happen. And invariably, money is not the problem. Money is a way to buy the resources you need to check out how you're going to make this thing grow. But, kind of hiring people, getting team members, identifying, suppliers, or, real estate, all these other types of challenges are all these little elements that people need to figure out, which are unique to every company. So you can give them the right amount of capital and then say, all right, that's enough for 12 to 18 months. And if you then achieve this large step that you're identifying with that money, then we'll raise double or triple that much, and then you have to go to the next phase. So you want to do it in that type of a fashion. I've actually seen, and you're actually seeing this right now, whenever things are frothy like they were in kind of 2019, 2020, when there's a lot of liquidity, a lot of startups get overfinanced, and then you hear these, disasters. It's hard to fathom how they blew through $80 million in like 2 years. And you're like, how, and with nothing, and they went to zero. So it's like, frankly, the idea had too many variables that they hadn't figured out yet. And they just thought they could solve everything at once. And it's like, it's interesting if you read, kind of histories of people. They always say, people think, oh, my startup, it's like, oh, you've been doing this for a couple of years. No, actually, I've been doing it for like 8 years. So the amount of time it takes to kind of come up the learning curve is not insignificant.
How many investments have you made through Chorus? And you can say that in absolute terms or in total investment value.
So through Chorus, we've made, I think, 11, which is somewhere around 5 or 6 million pounds. So small amounts. And then Opto, we just closed, did a first close of $1 million, did 3 investments right away. And we'll do the majority of those in the next 3 or 4 months. And then do another. There's a structure in the UK that we wanted to take advantage of called EIS. So it's easier to do it on an annual basis that way.
I might not have mentioned it at the beginning, but all 3 of your organizations are based in London. Is that correct?
It's not that we don't believe that there's impact opportunities in other places. I think there's a few things. One is that we think for startups, you need to focus on the area that you're in. So expansion's not the problem in the beginning. It's kind of making sure you actually know what you're doing. To that extent, it's good to be close to them. And also to that extent, investors, if they can kind of see it growing, they tend to be a lot more supportive. So there's, great opportunities, I think, in impact all over the world. Thing is I would find it very difficult to invest in something that's, let's say, 8 time zones away and believe that I could actually be knowledgeable about what they need to be doing.
Understanding your 3 organizations, the accelerator provides your pipeline for the two investing vehicles. One's a network, one's an actual fund. The accelerator, you told this phenomenal story at the beginning, how you live rent-free with it. How is it sustained now? How is that financed?
We have investors in the accelerator, but at the moment, we haven't run a program for a number of months now, for like more than 6 months. The reason being is that we're doing a shift where we're thinking about the challenge with startups generally is how much information or knowledge can you get about the startup, the opportunity, and the founder to kind of make sure you want to invest your time. And I think one of the issues with impact, which makes it harder than regular startup investing, is you really need to understand the motivation of the founders and make sure that it's aligned in terms of they understand the impact, they understand the business side of it, and does that work together? So we are looking at a few different permutations and thinking about that to kind of increase our yields, if you will.
When you say there's investors in Impact Central, where's the payback coming from? Where's the revenue?
That's a great question. So the structure that we do is for the companies, they come on the accelerator and then we take a 5% investment in the company in return for providing them with all the program and all the services that we provide them over the kind of 3 months. The investors are effectively investing almost like in a fund. The stakes are held in the company and they're investors in the company.
If I've understood everything you've said so far, the companies you bring into Impact Central, the accelerator, would likely line up with the values and the theory of change that the investors you have in Chorus and in Opto would likely invest in. So what would be Opto's theory of change?
The question is, how do you make a startup successful, or what can you do to make a startup successful? And from Opto's perspective, what we think there's a few things. First of all, we believe that being a founder of a startup is a bit of a lonely job. So most of your network doesn't really understand what you're doing. And also you kind of have different challenges and problems that you're trying to deal with. So ideally you want some people around you that have skin in the game, but that also can help extend the opportunity set that you have. So the first thing we do, there's 3 of us on the Opto, they're the partners in Opto. The first thing we do is we take a board seat. And so we're meeting constantly with the company, with the founder. And then the other things we do is identify what we think is kind of the primary issue or one of the primary issues that if we could solve this, that would move the needle forward a lot. So on a business side, I'll give you an example because I've already talked about the coffee company. After they'd been in business they're focused on wholesale. They're a roaster and they wholesale to cafe customers. They found that after about 18, 24 months, sales are going really nicely and they kind of were hitting a bit of a ceiling. And what they determined was that the mid-size and larger competitors in the space would finance the equipment for the cafes. So in other words, if you have a really nice coffee machine and grinders, that's going to be 12 to 15,000 pounds to do that. And a small cafe, if they don't have to pay for that, that's great. Now, the reason it works is because there's very good margins on coffee if you're a coffee roaster. And so, but what it does is it's a barrier to entry for anybody small. So these guys, there's no way they could shell out, 15,000 for every customer to kind of be competitive in that regard. So what we did is we created a leasing company, an off-balance sheet leasing company, so that they wouldn't look all of a sudden like a leasing company. So the leasing company had to be off-balance sheet. And then we identified a number of investors. So there were investors that were investors in the whole business. And then we identified people that wanted to do, like everybody's mantra right now is private credit. But this was already like 3 or 4 years ago. We would basically offer people 15% if they would finance a machine for 3 years. And it was a great lease structure. The company tried to go to leasing companies, but the leasing companies weren't interested because they were too small. So we had to create their own leasing company. But there were plenty of investors that wanted, it's actually a great deal. You get a secured asset that depreciates over more than 10 years that will actually be totally in the lease structure, totally depreciated in 3, earning yourself 15%. So back in the days when interest rates were 1%. So that was, we created that structure for them. And then all of a sudden, all of these opportunities that were not open to them became open to them. A lot of these cafes really wanted to have their coffee because their coffee was very high quality and they liked what they were doing. They were priced out of it because they couldn't bring a machine on board. So, that was like in some ways, maybe an existential problem for that business. If we couldn't solve it, they wouldn't have been able to solve that on their own. So, we came in and solved it for them.
I read somewhere you're focused on 3 core segments. One's branded consumer goods, another is public service providers, and a third you've called tech for good. What are the opportunities you see in these 3 segments?
The branded consumer space, that one's fairly straightforward. So it goes on the earlier premise that I was talking about, which is that the consuming public wants to see change, environmental and social things. But they have no great opportunities to do that. In other words, it doesn't mean a lot for people to donate £5 here or £10 there, but people consume a lot of goods. So if we can get the companies to actually incorporate some of these things and provide people with services and goods that they would normally be purchasing anyway, then, that's one way to actually really move the needle. Now, interestingly on that, people say sometimes, well, do you expect like a consumer goods company to be as big as P&G? It doesn't have to get that big. It just has to get big enough to be annoying. In other words, the large companies will start paying attention when some of their sales starts draining down because customers are showing a preference. Right now, customers don't have choice. So if you want to see if customers are if you have to adopt some different principles about your supply chain, if somebody else is doing that, that's where we'll see change. And in the meantime, some of these smaller companies, if they become, medium sized, the returns can be phenomenal from an investing point of view. The public goods usually come about just, frankly, as a result of probably, I don't how to say this, just bad politics. We have a lot of inaction, and yet people do care about certain goods. So an example I could give there is healthcare. Generally, healthcare is an area where, unfortunately, inequalities become very large. So wealth inequalities have huge impact on healthcare outcomes. Since the pandemic, even before the pandemic, there were a lot of mental health problems in society. It was a growing issue. It was seen to be a growing issue. If you're wealthy, you can pay for a therapist. There's plenty of therapists out there, but that becomes harder and harder as you go down the income scale. So, for example, one of the companies we're working with has a solution where they have expertise in doing group therapy and things of that nature, but they also have a solution that they're building that is much more scalable and that therefore drops prices down using a number of different techniques that they have found to be very effective. There's 2 customers there. One is corporates. So corporates are really struggling because a lot of their employees are suffering from mental health issues, and the corporate doesn't kind of know how to deal with that. So there's corporate customers that are interested. And then ultimately at scale, you also even could have governmental organizations and other people interested. So, it's kind of like realizing areas where there's scope for a large shift. If you could offer something different that's more effective. So that would be kind of in that realm. And then the tech for good is, I would say, the trickiest one to get right. And the reason I say that is because I see so much kind of tech for good that is actually kind of greenwashed. It's they want to kind of say they're doing this for a good reason, to get support for it or to get funding for it, but actually it never goes to the people that they claim are their beneficiaries. And, an example I could use on this was from my kind of satellite background. There was a company called O3B back in 2007, which sent out, pitch decks. They got, I think, over $1 billion in investment, and their O3B stands for other 3 billion. So the 3 billion people on the planet that don't have internet access, they were going to provide internet access. And they had these, like I said, they had pictures of all these schools in Kenya and hospitals in Indonesia that were all of a sudden going to be put onto the internet. And it was always kind of like, how exactly does this business model work? And ultimately they went bust and got bought out, or not necessarily went bust, but they got bought out by SES And that is why now there's internet on cruise ships and airplanes, is their constellation is used for that type of, and some military uses. So I think that the challenge with tech for good is that when oftentimes there's good intentions, but it can get easily repurposed if the returns are higher. And I kind of see that a lot on the tech for good front in opportunities where there's kind of a false economy or a false thing. But, fundamentally, there's so many issues that we have that could be made we could be a lot more effective if we applied technology better. So we do find opportunities occasionally, and not necessarily always information technology. Sometimes, for example, working with a company that is using onion skins to develop new types of packaging, so to get rid of plastic packaging.
Describe your typical investment model and your actual investment process and how you screen deals, both financial and non-financial screens, and due diligence, and how you get to the point of pulling the trigger on an investment.
So, as I was saying earlier, we talk about kind of the first element has to be for profit. And although we are definitely impact investors, it is always the first step is to look at a business and decide whether it's a viable investment. We were talking about definitions earlier, and this is kind of where I think the definitions, when it becomes too broad, become unhelpful, because I've seen a lot of people that have kind of told me about their impact business, but it's really never going to work. It's if they should maybe make it a charity, because it's just never going to become, as you say, it's kind of the minimum definition for sustainability. It has to be able to pay people to grow and to create things that people want to pay for. So in the first instance, it's probably no different than anybody would look at an investment and say, is there a horizon that this investment is going to grow and, create a financial return for investors subject to a certain, let's say, identifiable number of risks that we think we could understand and could help so that we could reduce those risks and make it more viable. So that's where we start. A lot of just financial modeling and also looking at the market and deciding whether that's of interest or whether the services, what does the competition look like to a large extent? Are people generally unhappy, and would they, if given something like this, would they make that switch? And as we're kind of doing that, that's where the next part comes into it, where we kind of start looking at the impact. And on this side, sometimes we find things that are just so minimally impactful, or when people say, well, I'm going to give 1%, or I'm going to plant a tree. And it's like, that's not really doing anything. It's like all you're doing then is taking money out of your customers' pockets. They could just do it themselves. So we don't see that as being kind of an impact investment. It has to be more that the well-functioning of the business will actually grow the impact commensurately. So then when we're looking at that, we're saying, okay, and this is actually quite important. We spend a lot of time with the founder on this to say, do you really, how do you know? So we worked with a guy who was interested in dealing with a kind of food poverty. And he had spent 3 years volunteering in food banks in addition to his job. So he knew the problem. He had talked to tons of people. He knew what it was like to go into a food bank. He knew that, kind of where the challenges were. He saw the things. This is ridiculous. We shouldn't do this and do it this way anymore. He knew what technology could do. Then it becomes a very important conversation. Do they actually understand the problem that they're trying to alleviate? A lot of people say, like a classic one is, I want to end homelessness. And it's like, but, why? Because I don't like seeing them on the street. It's like, well, you really don't understand the problem. So we make sure that it's not just kind of it would be great if I could be in the newspaper solving homelessness. It's like, well, you got to have a little bit more interest and understanding in the issue to make us believe that, you're worth spending time on. So that's kind of that. And for that, we also look at what is the cost of that intervention in terms of what is it delivering? How is it impacting the business? Are there ways that it can be communicated more effectively to make the customers more interested in supporting the business because they really want to see this change and they believe it's happening? We also, frankly, try to be quite honest with ourselves. Is this a sector that we have some expertise or we know some people that we can bring on board that are going to make a difference? I got to know a gentleman. I don't know if you know the clothing company All Saints, but he's the founder of All Saints. When we talk to some of the fashion opportunities, I call him up and, have him meet with them. And one of them, he's joined the board. So it's kind of, people that really have spent, a number of years. Are they excited about this? Do they know, what have they seen? And do they really believe this is something that could be addressed? So we try to be that comprehensive. And then, the first step really is with our initial investment, which will be small, maybe up to 500,000 with, kind of something of, like I said, we invest between 50 and 500. What is it specifically that's going to change in the business and the impact to demonstrate viability? Because we know we're just the first step of probably 3 such raises before it even becomes very interesting. So we need to feel like we have a clear plan on, okay, over 18 months, this is what could happen. We believe that's viable. The founder also agrees with us on that. And so great, let's go do it. And that way we then also kind of put some stakes in the ground so that we can legitimately look back 18 months later and say, we might have been wrong, but do we know why we were wrong? And has it changed a little bit? And this is the thing with startups, right? And it's on the impact side too. It's not linear. If you knew the answers at the beginning, it wouldn't be a startup. Then every corporate would just do it. So there's a lot of unknowns, and the process of innovation and problem solving is fundamental to a successful startup, that it kind of solves these problems, tries a lot of things, and tries to optimize the path forward so that it can achieve profitability and the impact that we're looking for.
So you're investing in businesses at very early stages, and therefore you're investing in the potential of the business and the founding teams. So can you walk me through what you look for in an entrepreneur and what you look for in a business model and what you look for in terms of an impact model?
Entrepreneurs is, that's really hard. They are the most important element by far, the individuals. I always have to maintain a sense of humility in this because it's easy to kind of have a mental picture of what you think this is going to be a successful entrepreneur. And I have found time and time again that it doesn't match up. I would say the one thing for sure is their motivation. And I think part of that is because I think you have to have a certain mindset to be a successful entrepreneur. Part of that is just personal. Myself and in my 2 partners at Opto, we want to make sure that we're aligned in that motivation. In other words, you don't want to be at cross purposes with the motivations of any of the founders that you're working with. You want to make sure that the main thing they care about, you really care about that too. I find it's like there's a certain kind of chemistry that then kind of comes together just in the conversations that you have with them. There's that excitement or that, okay, and what about this or what about that? And then you can kind of see, and they start to see that you're really interested in, and that's kind of, it sounds kind of intangible but fuzzy, but it's really important, I think, in the successful relationships that you have with entrepreneurs. On the financial side, I guess, having been an investment banker, I'm just never too overly impressed with financial models. People I've spent 40 hours in a row building models, so I know what models can do. It's like no one really is ever going to wow me with their model. If anything, I find people overcomplicate it. So I find maybe for me, my litmus test is, do you know the financial things that count? And are you focused on those? And I find that a lot of times people, they come up with these elaborate models, but frankly, in any business, there's a few different line items, whether they're on the revenue side or the cost side, that are going to drive that particular business. So it's like, okay, how confident are you of that number? And how did you get that specific number? And why do you know that you can continue to source at that price, or that you can continue to sell your product at that price? What evidence do we have on that number? Because too often it's like fingers in the air and people are like, and I tell them, oh, it's not profitable enough. And then a day later I get a new model and it's much more profitable. And I'm like, okay, that's ridiculous.
It's the old backward exploding spreadsheet. We know the answer.
Exactly.
And what about the impact? What do you have a framework for the type of impact that investment has to achieve in order for you to pull the trigger and put money into it?
The impact is also you have to put a lot of thought into the impact in startups, because I think one of the problems that, kind of some of the larger investors do on impact, especially in startups, is they demand a lot of measurement early on. Measurement is costly. It takes a lot of time and effort to measure things really precisely to that type of a number. And frankly, in the beginning, it may be irrelevant, because just like you're going to make, people accept that in the business, you can make all kinds of different pivots. I mean, that's just part of, early stage business. You might also have to make some changes on the impact. So the way that you deliver your impact could change. And, how are we going to adapt that? It might be better. It might be something that we've discovered that makes it so much easier. Actually, great example. This is actually a different business on mental health that we worked with. They identified that kids in school, so mental health, a lot of people in kind of high school, secondary school kids, they start suffering from mental health. The problem is that nobody in the administration or anything is like kind of trained for that. And so until there's like an attempt at suicide or something like that, people aren't aware of it. Now, if you became aware of it 9 months earlier, you probably could have diffused that whole thing with just a conversation with someone who they trust. So instead of needing a licensed, trained professional doctor 9 months later with, a year of therapy, some conversations 9 months earlier would have, changed that trajectory. The problem, though, of course, is how do you go about determining who's kind of entering that, let's say, that pathway that's going to go badly. And so these three guys, brilliant guys, had this idea. Well, we're going to use AI. Kids are on phones, and we can look at their messaging, and through their messaging, we're going to be able to figure out algorithmically if there's increasing levels of stress. And I thought, okay. Yeah, I buy that. This is on the accelerator. So they were, one of like 30 people that applied that we took onto the program, that particular cohort. And, logically made a lot of sense. And part of the reason we take them on that program is to really dig into it and figure out, what holds water? What's true? What's not true? And so they spent a lot of time. They had one guy who I think worked at CERN. So he was like, brilliant programmer. And, if someone was going to figure this out, how to do this algorithmically, it was him. So they worked on it. And then it turned out, though, that they struggled a bit with getting schools to kind of give them students to test this on. So time went by, about 9 months went by. And the guy who was like the computer expert guy kind of, as he would, had a lot of other opportunities. So he kind of started not being that involved. And then this opportunity came, actually 2 opportunities came with 2 different schools. And so they're like, great. So they end up running a program where they're going to kind of, find out what students, which ones are having problems. And it turns out all you have to do is ask them. You don't need an algorithm. Students are very open. So they basically changed it, ran surveys. And what they found was absolutely hysterical. So this one administrator at the school was like, oh, our students love us. They think we're the best. They come to us with all their problems. So they get back like 800 surveys, and like 80% of them, like, the administration has no clue. We don't talk to them. And it was just, that disconnect. So it's kind of, in terms of, where we thought the whole thing was, the impact was all going to be driven by this algorithm, that we were going to get all this data. It turns out all you had to do was ask them. So 90-degree shift also reduced the cost of it dramatically. And then with COVID happening, all of a sudden there was huge demand for their application.
So could you give me one good example of an investment that your fund has made that demonstrates the type of investments that you would prefer to make? How did you identify this deal? How did you get down to making the investment decision? What's the impact it's had, and how do you measure that?
I guess for a number of different reasons, I would probably go with the coffee guys, Newground. And I think the reason that I would go with that is that on the face of it, there's no reason why they should have been more successful or why it should have worked out more than some others that have not worked out. The characteristic, and I was actually just talking to someone about this the other day. We generally are, we're always very cautious in terms of how things we're analyzing, making sure we're asking lots of questions. And so you always, by the time you're making the investment, we've ticked all the boxes. We have identified the financial model that will work, subject to revenues matching that, and we believe that all makes sense, and we're in that. We've identified, the 2 or 3 things that we could really help them with, that we can either ourselves or bring other people on board, so that should happen. And we have the impact identified, and we figured out kind of, okay, this is how this is all going to work together. So we tend to feel very confident about everything before we make that investment. With Newground, I think the factor that I think has worked out particularly well is that they work really hard, but they avoid the roller coaster. And what I mean by that is they focus on their work output and not the outcome. And so the problem that I've seen with some brilliant founders that haven't worked out is that they got a bit depressed because they were convinced that this company was going to be their customer. And because they had one positive conversation with someone at the company that gave them this idea that all they had to do was this, and then they would get that customer. And so they kind of kept funneling down into a particular customer or a particular process that, is the only way they could do this, that this could happen. And it can become very negatively reinforcing because it almost turns into desperation as it starts kind of collapsing a little bit, that their kind of ideal trajectory starts to fall apart. The reason I think Newground's really interesting is because, so it started off and it was only about wholesale coffee. Then COVID hits, and within 1 week, they lose 90% of their sales because all the cafes closed. And so they said, we always wanted to try online coffee. And so they switched 100%, started doing online coffee. And within 4 months, they had more revenue in online coffee than they did with their cafes. Then, COVID ends. All of a sudden, they have 2 revenue streams. So it's kind of like, the adaptability is kind of like a Darwinian thing, right? It's like not the strongest, but the most willing to adapt. And I think that you will not know what is going, what are the positive things that are going to come in your direction and what are the negative things. But if you focus on the work ethic and the work output and just bring as many opportunities as you can, God willing, you need a little bit of good things to happen in your direction, but you just have to bat more than 500. You just have to have more things working than are not working, and then be patient.
How did they come onto your radar?
So that's been really interesting. They're on the first cohort. So when we launched the first accelerator so this was, beginning of 2018, there weren't a lot, impact was much less talked about at the time. And these 2 guys, they were both kind of, I would say, definitely coffee nuts. They just loved coffee and all kinds of, they would read coffee magazines or whatever, do all kinds of crazy stuff. And interestingly, one of them had grown up in a bad part of Liverpool. And when he was 10 years old, his dad was transferred. So for whatever reason, he got out of that bad neighborhood, but he stayed in touch with a couple of his old friends, some of whom ended up going to prison. So he was aware of, he was like, it's a good guy. But his life is like, kind of over. He can't get a job. It's like horrible. And so he thought, my passion is to do great coffee, but I would really like to do this in a way that I could also give opportunities to guys like my friend, even though, his friend's like in another part of the country, but like to people that are trying to, it was kind of that came together, and yet most of the people they were talking to were like, well, how are you going to make money? And it was like, versus when he came and talked to us, we were like, well, yes, how are you going to make money? But also, how do you see this working with the impact? And he and his partner both felt that was fundamental. They didn't want to just run a coffee roastery. And in many ways, what's interesting, as time has gone by and people have become more interested in impact, they won an order. They also now sell pods and do some other things. And they won a big order with a hotel. They were up against the 3 best specialty roasters in the UK, and they're also considered one of the best. They were like, he gave them feedback and said, well, you won, but you didn't win because of your price. You're not the cheapest. And he goes, you didn't win because of the coffee. He says, frankly, you and the other 2 are the same. I mean, it's great. He said, you won because we want to show our customers that we care about these things that you care about. So in a way, that thesis that I've been talking about the whole time, it was great to see that evidence come through. People are starting to care. People are willing to pay for people that are doing the right thing.
So I imagine the impact from that investment is the changed lives of these ex-convicts. Do you have a way that you're tracking and measuring that?
So for those, what we do, there's a few different things. The first thing is to run a program. So first you have to identify them. You have to you can't just randomly pick people. So what Newground has done is they actually go to a particular prison and they offer a kind of 1 day, this is what coffee is about. Here's how you do this. Here's how you do that. And out of whatever, 10, 15, they find 1 or 2 that kind of say, oh, that's kind of interesting. And I'm going to get out in 6 months. And so then what they do is they start working with them on day release when they would come, and they would, kind of work with them only a couple hours, and they have to go back to the prison. And then they kind of identify which ones they could then train even further to then be employed, with the idea that they would never, the idea is not to make them permanent employees of Newground, but to move them on so that they can bring more new people into their business. So a few different things. I think one thing that we've always measured is, anybody reoffending. And so far, no one's ever reoffended that's come on the program and that's worked with Newground. The other thing that we're doing now, and they've just hired somebody who's going to start in March, is to both increase the number. So we want to do 28 this year of people that come through the program, but also then identify some additional KPIs in terms of, it's complicated. Someone who's been in prison, it's not just the time they spent in prison. They probably had a pretty rough life before that. So their views of work and showing up on time and, collaboration and other things, that's a lot of times it's kind of these soft skill training is the training that's needed. And so it's difficult to kind of quantify that or to figure out what the KPIs should be to make sure that gets done.
How do you approach your investment exits?
The question is, a time scale, and this is, I get this a lot from investors in impact, is they say, well, how am I going to get out of this thing in the future? I think there's a few different pathways. It's different than non-impact companies because you need to be very cognizant of the impact and how is that going to be maintained. So there is potential increasingly for corporates that are, if it's a consumer goods company or something like that, to purchase the company to do a buyout. The thing, though, is you have to look hard at, okay, are they buying the brand, or are they going to dismantle the supply chain we've created and just use their own, which would kind of defeat the whole purpose? Or why are they genuinely interested? And I guess this is kind of one of the, I think, challenges is that you have to make sure that investors are aligned on that too. Frankly, if investors are not interested in the impact, they shouldn't do impact investing, because arguably you're going to be upset if someone doesn't want to sell to a company that's just dismantling you. The other one, frankly, is importantly, I would say, we always have to look at businesses, not just products, or not just like a small kind of thing that'll be bolted on to something else. And that takes longer, to build a business, which includes like sales and infrastructure and things like that. But it's also has more longevity. So, you have, when you're reaching profitability, you have growth opportunities, and you can look at possibly paying back some dividends or doing some share buybacks and other types of things, which would provide some smaller forms of liquidity to investors. So there's kind of, those elements. And then as they get larger, there's opportunities to sell out. And then the other one that I think is not insignificant is, as I mentioned, my friend and other people I know that have set up funds, they complain about the pipeline. They don't have things where they could put, 25, $50 million into. And, these startups they have to grow quite a ways to get that large. But at that point in time, then some of these investors would be willing to take people out. And a lot of times, so for example, the last valuation we did for Newground was around 8 million. If they, let's say 18 months from now, if they're valued at say 20 million and they might need some money to open another site or something like that, they would only raise probably $1 million or $2 million. So and that's still a small chunk of money. So what would then happen is some of these investors say, well, I want to invest 5. I'll do 2 million of primary, and then I'll do 3 million of secondary to take out some of the existing investors. So, it's a bit of, I don't think it's, although it's like probably not true in the tech space either, but a lot of times people in the tech space kind of see it as a one-stop ending. In other words, I will get bought out and I'm done, versus I think on some of these, because they're businesses, there's some different opportunities, but it might be piecemeal.
You're investing in early stage businesses. How do you think about measuring and managing and ensuring the impact outcomes of an early stage business when so much of the potential impact is unknown and it comes much further out in the future?
This is both on the accelerator and also on the investments, where you need to do two things in particular. You need to look at the functioning of the business model. In other words, is the impact fundamental to the business model such that it would be a totally different business if you took it out? Because of the expectation of customers, because of the way it's been pulled together, because of how it operates, kind of, is it part of the ethos? And I think that if you're not totally convinced of that, then I think there is a real danger that at some point in time, when business gets a little bit difficult, that they will jettison the impact and just focus on what they say, surviving. It's hard to go against the logic of, well, if there's no profit and the business goes under, there's no impact anyway. And that's true. But the thing is that is it so structurally integral to the way the business has been set up that there's no way that it would be, they kind of work hand in glove. And then the second part of that is really talking to the founder. What's their motivation? What are they hoping to achieve? It is always interesting to, talk to founders. First-time founders, they often kind of have this, there's the problem in all the literature is there's massive survivorship bias, right? It's like the only people you ever listen to are people that made it. I've had I would say it's a privilege. I've had the privilege to talk to lots of people that had to close their businesses and how gut-wrenching that is and how difficult, why they had to do it, why they decided that, this isn't going to work or it's not going to work for them. And also there's kind of information that first-time founders especially, but even serial founders, when you're starting something off, you just don't know how it's going to develop. And so I just find that, I've said this a couple of times, but the kind of adaptability of that founder, it's like there's a core thing that they believe in, but there's lots of different ways it could be achieved. So you don't want them to totally drop this core thing because that's why we're doing it, or this is the business we're in. Like, I don't want the coffee guys to call me up one day and go, coffee's out, we're doing donuts. It's like, that would not be I would not like that. I'd be like, that's not what we invested in. So, similarly on the impact side, you wouldn't want to see something like that. So there's kind of like a bit of a North Star element to it. But at the same time, you want to have that sense of flexibility, adaptability that, hey, the point is to get there. How we get there within certain constraints is okay. There's lots of different ways to do that.
What does impact washing look like to you, or is it even a thing in your space?
I think it's a big thing. I divide it into kind of two camps. The one camp, which is the obvious one of people that kind of do or say something that they kind of know is not really true. I don't know if you saw, but recently the EU has just passed a law against that, right? So, regulators are starting to crack down on that what you say has to actually be true. And so there's that kind of one, which, and I put that in one camp because I kind of feel like that's the obvious one. That's the one that we're, hopefully we can do a lot on in terms of eliminating that. I would say the more difficult one is maybe even on the everyday consumer side of things, which is to hold a cognitive dissonance with an issue. So it's to know that, this product was probably made under pretty poor labor conditions, but it's cheap. I got to use it, and to forget about it. And so it's kind of, in a way, obviously people need to have information, but I do believe the second category I'm talking about is when we have information or it's fairly obvious, yet we dismiss it because, it's inconvenient. And I think that, unfortunately, that one is kind of the more, it may represent a much larger part, but fundamentally for us to deal with some of these issues, on some of the consumer products we're talking about, would you pay an extra 10 cents to have something that is clean versus not? Small changes, if you add them all up, could be really big, but even the argument to say, that's too insignificant, it won't make a difference. It's like, actually, if everybody did that, it would make a huge difference.
How does impact venture capital investing differ from other types of impact investing?
In some ways, I tell people, our biggest problem sometimes is the misconceptions caused by just tech, which I know very well in the VC space, versus kind of what some of our early stage investing is trying to accomplish. And what I mean by that is early stage tech and even private equity tends to try to maximize the risk profile, because the more risk, arguably, the greater the return. So you're going to go for something really groundbreaking that's disruptive on the technology side, or frankly, on the private equity side, you'll have so much leverage that, if it works out, it's going to be fantastic and we're going to make, 25x our money, et cetera. And so there's this expectation, I would say, that's kind of always around venture capital, that it is like drastically binary, and that the risk is exceedingly high, but, the payoff will be exceedingly great. And I think that on the impact side, there's opportunities where that doesn't have to be that extreme. So in other words, the risk of the business is lower, the capital intensity of the business is lower. So I'm not saying you can never guarantee any business is going to succeed, but there's, let's say, the levers that you need to pull for success are kind of known, and it's a function of, can we execute well? If we execute well, we actually have a pretty decent chance of making this work. If we execute phenomenally, we could do great. If we execute so, it kind of works and we kind of maybe break even. And then, it could still go badly. No one's interested in that normally in VC. In VC, it's normally, no, I want it to be 100x or 0, and I want it to happen in 3 years. And so that kind of difference of opportunity set can make it difficult to communicate with investors sometimes, or investors, they kind of hear this, they've got it ingrained that this is the binary nature of this must mean that it's very low probability.
But you're talking, I think, about impact VC versus traditional VC.
Yeah.
What about impact VC versus impact? Not necessarily in the VC space.
That's a great point. I think this is a I know some people share my opinion on this. I find it very difficult for to see how buying and selling secondary investments in public companies can really achieve impact. Having worked with large public companies, they don't even know. They have no clue who's buying and selling. And even on the institutional side, they just meet mostly with research analysts and other people like that. So the opportunity to really influence decisions is very low. And then there's other factors in the compensation structure and how things are done in other businesses, especially public ones and large companies, that just make it really hard to achieve kind of an impact outcome. Our objective is that because we're starting at such an early stage with companies, we have this blank sheet of paper. We can make sure that the investment objectives are aligned with the executives or the founders' objectives, that aligns with who we think the customers are going to be and the stakeholders. So we're all clear that we're all heading in this direction. And there's as I said, there can be a number of different paths, but in general, this is where we're going with it. And everybody a lot of people can win in that direction. I just think that it's just really effectively, if you don't have that alignment, you're kind of counting on altruism. It's like I find it difficult to believe I'm going to have this is what I was saying early on, when I went and spoke with these former colleagues and clients of mine. It's a difficult thing to ask. It's like, okay, you as an individual, you're an executive of a company or you sit on the board, you have your own daily problems. Why should I be more altruistic than anybody else? And that becomes a different, and also are you willing to put yourself up to additional scrutiny, et cetera, et cetera, et cetera. It becomes I'll do my best, I'll do best efforts, but can we actually put frameworks, measurements, things like that? So I find that I would say if I wanted impact on the public side, I'd focus on regulation and politics. I think, that's part of that equation. But on the investing side, I feel that you have to kind of roll up your sleeves and make sure that the actual execution, the people doing the execution, that there's total agreement. And so that's why I focus on the early stage space and the VC space. If we do it right, just like it's hard to, remove the structure on a large company, if we have a good structure on a smaller company that becomes larger, that good structure will continue. So there's it's not that only small companies can do this, but it's just that you have to, if you start with a better structure where everything's aligned, it's easier to continue that way than trying to dismantle something when it's huge.
What's the profile of your fund's typical investors, and why do they invest with Opto? Is it passion? Is it mission? Is it returns? Or maybe it doesn't matter to you. You're just happy they're investing then.
It's always great to have investors. But I'd say it's a great question, because I tell people that I often have, this really interesting job, because I spend 80% of my time with people between 25 and 40 that are passionate about founding something and changing the world in their thing. And then I spend 20% of my time with investors. And they tend to be I think it's just a product of the space that we're trying to raise capital in. People that with the type of ability to invest 10 to 100,000 or slightly more, they have a certain wealth profile that generally doesn't get accumulated until they're into their late 40s, 50s, etc. The reason this is so interesting, though, is because on two reasons. First of all, the younger set don't think that the investors get them, and the investors don't think the younger set understands what their objectives are. Part of that, I might say, could be just simply generational. But the other part of it is simply that the urgency, or the way that people in their late 20s, early 30s are thinking about some of these things, and let's say the energy that they're willing to put into it, is typically not shared with people who have kind of built a career or have seen their career by working with companies in a certain way. And they kind of take the point of view, well, that worked fine for a long time. Does it really need to change? So there's, it's difficult, and I find it difficult on the fundraising side. Oftentimes, the catalyst is their children, or the fact that something has come about where they recognize that actually business as usual isn't really working for us anymore. So it's there almost needs to be a little bit of that realization, which unfortunately the majority of the asset management industry, when people kind of head towards retirement and older, the mantra is just super conservative, right? So it's kind of, look, you just want to get your 8 to 10% a year with the minimum amount of volatility. So, trying to tell someone like that, I got something that could turn out great or could go to nil. It's like, that's a totally different speech than what they're getting from their wealth advisor.
Do they skew younger then?
No, I would say, so in the fund, I think we have 24 investors in the fund or something like that. And I'd say the majority tend to be, in their, 40 or over, just because of the profile that I talked about. There's some people that have made money younger that have money to spend on these things. And also we look for our investors to also co-invest. So to put more into individual opportunities. So they need to have additional funds for that. But, I would say that, you have the conversations with people and like with investors. So, your audience, it depends on how much time they spent raising capital. That's probably a whole podcast in and of itself. What's it like raising capital? It takes 3 times as many conversations as you think it's going to take. And I've done this for 30 years or something now. I still don't know when I start a conversation whether I've had so many times where I've been absolutely convinced. I'm looking at my watch going, okay, what is the shortest amount of time I can end this meeting because it's not going anywhere and I have better things to do. And ultimately they invest versus other people that I've spent, limitless numbers of meetings with who keep telling me that they're just about to invest and never do. So the kind of trying to get that right is really complicated. I'd say the other thing too is what having raised or worked professionally in asset management. What I mean by that is all other actors being professionals. So in other words, the products and the investors, that's easy. Because when you call somebody, their job is to invest. So they will take your call, they will listen to you, and then they'll tell you why or why not they want to invest. At the numbers that we're talking about, 50,000, 100,000, I've had it with, people say, oh, sorry, I'm going on vacation now. I got to go. So it's like it's not their primary job. So they might be particularly inspired. They might have a windfall, which makes them, want to support something. They may have seen something on a documentary that, has inspired them and they're looking for a solution for that. And then the other thing too is they oftentimes feel what can also be challenging is they're trying to be too particular. So it's like, I'm sorry, but for even 100,000, I'm not going to modify the portfolio for you. It's like, they're like, I've had people say, they want to invest like 25,000. Like, but I only want to invest in the businesses that have been started by women. It's like, well, that's half of them. It's still, a great proportion, but there are half that have not been founded by women. So I'm sorry, but I can't cut the fund in half for you. But, you get people that want to, they think they can carve out or create whatever they want. And, I wish them luck in trying to find some other way to do it.
What do you see as the role of artificial intelligence within your tech for good paradigm? Are you investing at all in AI? And if so, where?
I haven't seen anything AI, specifically AI for good. I think that most of because I still, know a lot of people in VC, I still see a lot of decks and stuff like that. And most of the AI stuff that I see, it's starting to change. But for the last couple of years, it's been all about, building out capability as opposed to application. So versus a lot of the impact stuff is going to be application based. It's not going to be hardcore tech. So it's a bit different. I guess I would say, though, that my background in engineering is as a systems engineer. And I do have some concerns about AI in that regard. So, it's kind of AI applications are generally looking at outputs and trying to make them as efficient as possible. Without necessarily, but that's not what we used to do, right? What we used to do as systems engineers is we would try to understand the whole system and then tweak the various parameters to get the output that we wanted or the best possible output subject to certain constraints. The way AI generally works is like we're going to optimize the output and we don't know what those parameters need to be. And that's why we need AI, because it's going to tweak it in ways we wouldn't have thought of because that we don't know that the system works that way. The problem with that is ultimately you come up with solutions that you actually don't know. You don't know why they work. You don't know why it's the best solution. And it could be the best solution because it's actually doing certain things that you don't want it to do. So it's having negative externalities on other parts of the problem that are going to create problems. So I like some of the things that have been developed in AI when they're quite constrained to particular things, but I worry about other solutions. So for example, I talked earlier about, job applications. People are like, it's wonderful. It's going to be massively efficient. It's like, yes, if you're a good type of applicant, life is going to get easier and easier. If you have some black marks on your application and there's no kind of, verification or how this thing works, you're going to fall out of the data. You're never going to get a job. So it's like, I worry a little bit about from an impact perspective. It's like, we don't know kind of what are some of the things that we're optimizing for. So what are some of the problems that we could be storing up for the future?
I guess we're all going to wait and see how this plays out. Huh?
Yeah. The other one is also environmentally. I mean, a lot of people aren't aware of the energy drain from AI is massive. So it's massively damaging environmentally because of the amount of power that it takes to run AI chips.
If you had to name the single most important challenge in the impact venture capital space at this time, what would that be?
Yeah, on that, I would say valuing impact. And it's been the same for a while. It's just that my impact and the way that the things that I value in impact are different from what somebody else might value invariably. So financial is very simple, but impact is complicated.
What do you know now about impact venture capital investing that you wish you knew when you founded Opto and Impact Central?
I don't know if I know it yet. It's like I know what I know the problem that I've been struggling with, which is how to. So as I said, the assets are held by a certain subset, a demographic subset, which is not necessarily the subset that is most impacted by the impact issues. I think I had an inkling of that, but after hundreds, if not thousands of conversations, the challenge of getting people in the demographic that have assets to be a bit more broad thinking in the societal, kind of what are, other than financial returns, what are the things you care about? And they care. They have grandchildren or children, and they do care about these things, but they don't think that their assets need to do anything about it. So communicating that better still is really the tough bit. It's like, how do we migrate the assets to better serve us, collectively and even individually?
You don't have to name names, but can you describe to me an example of a deal, an investment that you were convinced of at the time you invested, that it ticked all of your impact boxes, but in the end it didn't turn out and went pear-shaped? And what did you learn from that experience?
There's kind of a couple that come to mind that actually have the same common denominator. And I would say the variable is always the founder. And I try so hard to learn everything I can, but there's, so many, they're leading their own lives too, right? So it's kind of what's happening in their life and things that, kind of happen. There's so much uncertainty in startups that you really need people that have just high degrees of stability to kind of get through that and not kind of, lose their minds. So it's really kind of trying to I would say I've been, on positive and negative. It's like it's usually kind of some characteristic of the founder that I've seen great businesses tank that I'm like, let me run it. It's like, this is a great idea. But they've had it. They're just done.
And now the converse of that, can you describe an investment that you had some level of skepticism, either at the time you invested or maybe you ultimately passed on the investment, and in the end it turned out way better than you thought and you were pleased you invested, or if you had passed on it, you wish you hadn't? And what was the lesson learned from that experience?
I think that on a personal level, and this is a bit of a personal challenge that I have, is I'm definitely theoretically involved in this. Like I believe that impact investing can work. So I'm just always I'm always the biggest fan of any guy, any individual that comes to me and has an impact idea. And I want it to work. I want it to work because I believe I'm not in this kind of like, I want to pick a few winners because if my fund does better than another fund. I feel that the stakes are totally different here. The stakes are that we need to have as many of these types of businesses work so that larger businesses, more businesses, everybody starts kind of identifying that this massive, the commercial economy gets utilized to a much better, way to solve our problems. So I guess, I tend to be overly optimistic or to believe, I guess the way that some founders have told me is like, I care more about their business than they do. So it's like, I kind of, maybe to the extreme sometimes. So I would say that, I think I really believe that this is important. And sometimes get a little bit too passionate about it.
If someone wants to get into the impact venture capital space, how would you advise them to get into the business, and where should they start and cut their teeth?
There's a couple elements here, and we've talked about quite a bit in this discussion. It's like impact investing is really hard because it's two things, right? You need this viable. You need to know what you're doing in investing generally. You need to know that what you have is a viable, quote, investment. It's not a charitable project, but it actually is a viable investment. And at the same time, you have to look at the kind of understand the impact. So it's kind of like on the one side, there's lots of information that you can learn about. Read various investors and books that people have written about investing. I think on the impact side, the way specifically for impact investing, though, you have to meet people. You have to kind of talk to people that know about the problems, that have ideas, and then meet with them to kind of hear their solutions. And from those discussions, you'll then start to get a sense of what you think is viable, what would be of interest to invest in, and what you kind of start imagining the changes would need to be for that to work even better. I guess the last thing I would say, though, is do something. And what I mean by that is it just ultimately you're going to fail. There's going to be failures in the businesses, failures in the investments. And, it's in the early stage space, nothing is obvious. If it was obvious, people would have been doing it already. So that's part of the reason to do it, is that you believe that positive things will come about, that you have to try things. That's the only way you ever know. I know lots of people that, talk about impact till forever, and it's just talked about, but actually don't go to so many chat rooms, and instead just, when you find something interesting, jump in and give it a go. If it goes horribly wrong in 3 or 6 months, you will still have learned so much more than spending 3 to 6 months in chat rooms.
Gordon, I think we're there. We got to the finish line. It was really great talking to you. Thank you very much, my friend, for taking me through your journey and everything that you're doing. I really appreciate it. You have amazing stories. Now, tell everyone your websites and your social and all that good stuff.
Best way to reach me is usually through LinkedIn. So my profile on LinkedIn, and we have the two websites. One's impactcentral.co.uk. The other one is optoimpact.co.uk for where we do the investments. But, send me a message on LinkedIn and I will get back to you. Thank you, Scott.
Thank you, Gordon. Thank you very much. Goodbye, everybody.
You've been listening to SRI 360. If you enjoyed it, please hit the like button and subscribe to get future episodes. You can find an archive of all previous podcast interviews and more articles and information on SRI, ESG, impact investing, sustainable investing, and socially responsible investing at our website, sri360.com. If you'd like to read more lessons learned from world-class SRI investors, get a copy of Scott Arnell's book, Sustainable and Responsible Investing 360. It's a must-read for anyone wanting to know more about investing for positive social, environmental, and ethical impact, all with market financial returns. These are the stories and tactics of those leading the way as sustainable and responsible investing goes mainstream. Sustainable and Responsible Investing 360 is now available in hardcover, ebook, and audiobook format wherever books are sold.